Absolutely. Thank you for rain. Can everybody hear me okay? Can I get a thumbs up if we're good? Okay, awesome. Thank you. So I'm Dr. Brian Whitestone. I joined the CAN network about 5 years ago. I didn't really have the typical background that you might expect for an angel investor. I'm an oral surgeon by trade, came back east and really wanted to insert myself into the Ottawa network. And I came across the Capital Angel Network site, and I was really inspired to join for a number of reasons. One, I saw this as being an opportunity to both connect and collaborate with a group of really bright, experienced, and interesting people, first of all, and secondarily with investors. And it has more than fulfilled that expectations. I've just been so fortunate to meet a wonderful group of people through CAN. So that's number one. Angel investing is also a two-sided process. And the other part of this is it really provides you with an opportunity to gain exposure to dynamic and passionate founders and entrepreneurs. These are people who really seek to solve new problems, new ways of solving them, and their energy and passion are something which I'm really drawn to. So that was the second piece, and I guess the third, very simple piece is angel investing is a great way to gain exposure to alternative investments that are outside the usual stocks, equities, bonds, et cetera, et cetera. So I think those are the three main drivers, the impetus for joining CAN, and it's been nothing but rewarding, exciting, and fun.
Great. Maybe Brian O'Higgins.
Sure. My background is technology. Actually, way back in life, I was a founder of Entrust, and then also one of the co-founders of Third Brigade. So I spent a lot of time in internet security companies. I've been angel investing. I'm going to say it's probably over 20 years. I don't know when I started. I remember actually my very first investment was a company called Q1 Labs, which was very successful. It was ultimately an acquisition by IBM for around $500 million. So probably got it lucky the first time, but I worked with them and I was on their board and so on. And that really got me hooked in the whole deal. But I've always liked startups, and I initially just stayed with startups in the internet security space or other ones that were very close to me. But these days it's become, I've maintained it, and I really see it treated as a hobby. But like all hobbies, it can take up a lot of your time. So you have to kind of manage that carefully. So it's something I do. It's interesting. I enjoy helping the companies. I don't actually, I very loosely measure ROI. I like to be in the black on these deals because it's not a charity. That's other events, but it's I can't really precisely track it and say what the IRR is, but it's on the whole, if you have enough companies, enough portfolio of them, it generally works out. It's fun.
Thanks, Brian. Julia.
Great. Yes, Julia Alvich. I come out of the tech world as well. I helped co-found and grow Chipworks, a local Ottawa company that was involved with patent and technical intelligence. That was a great experience. It was something that ended in 2016 when we sold the company to Tech Insights, another local company. And after about a year, I realized I wanted to keep my hand in the tech world, but not full time. And I loved being semi-retired. It's the best thing. So I started working with Invest Ottawa as an advisor, one of the early stage advisors, which was great. And it gave me exposure to the startups. Lots of great ideas, lots of not so great ideas, but it was great. And I saw it as a way to start figuring out my gut for entrepreneurs and learning a little bit about which ones would be successful without putting my money at their door that quickly. So it's been good from that standpoint. And I've really enjoyed working with those entrepreneurs and helping them through those early stages. So some of them, either through that exposure or through Capital Angel Networks, I invest in. And I do invest in people first and foremost. I'm investing in those that I think are coachable, driven, passionate about where they are, and with original ideas. The more original the idea, the better, from my standpoint, because it means they're hopefully looking at a blue ocean instead of a red sea. And my push as well is to support women, and that's one of the reasons I joined Capital Angel Networks, because I wanted to see more women investing, and I wanted to see more women founders winning. And I continue to find ways to support them. And one of those ways was as a co-founder of a new program that is a Capital Angel Network and Invest Ottawa program called She Boot, which helps women founders get investment ready, and is driven by about 60 different women now that are supporting the program in different ways.
Great. Thanks, Julia. And maybe I'll actually put it back to you. You alluded to this a little bit around how you started to dip your toes in, and everyone here on the line is obviously trying to learn more and educate themselves. So maybe you can take us through how you educated yourself, into your first investment, and then maybe after that, as you continue to learn more about angel investing, what resources have you tapped into? And I'll put that question to Brian Whitestone as well after that.
Okay. So I'm the newbie of this crowd too. I've only been investing for 2 years, and the first investment I knew them before I was involved with Capital Angel Network, and it was something that I'd gotten to know the founder for at least 6 months, but eventually I came through the investment through the door at Capital Angel Networks, and also we're supported by Mars Investment Accelerator Fund, IAF, and that actually made it easy for me, because as a first investment, it was great to see the due diligence that IAF was doing and work with them, so it made it a little easier. I also I attended Capital Angel Network, just listened, came to Angel Investing 101, more than 2 years ago, and that gave me some grounding. And the other source is NACO. The information that I could gather from NACO, the National Angel Capital Organization, is fantastic as well too. Sorry, I'll leave it there.
Perfect. Brian, how about yourself?
Yeah, I think first and foremost, at the risk of being redundant, you just have to be passionate about investing and learning. And I think that really underpinned my approach to angel investing, is trying to understand how little I really knew. So as Julie indicated, surrounding myself by people much smarter than me in all these different disciplines made a world of difference. So that is plain and simply attending meetings, having a beer, food when we can, hopefully again soon, and just talking and hearing what people had to say about companies, their thoughts, their investing styles. So the meetings were invaluable for me from that point of growth. And secondly, I think, I learned a lot by just participating in due diligence sessions. For those folks who are not aware, that's when you really indicate a deeper interest into a company and you want to go further. The due diligence is really where you lift up the hood and have a good look underneath and see what's really going on, whether it's with the finances, the corporate structure, the patents, and so on and so forth. So that really taught me how to think and look about a company and really try and figure out what's really going on and what the future looked like. Likewise, as Julia indicated, attending conferences. I mean, NACO has conferences. They have a wonderful book, which I'm sure you'll pitch later, Nolan, which is an available resource, which, I read and reread. I think Julia's got it there. Yeah, thank you, Julia. That is a fantastic book. It's available free of charge through NACO. And that just sends you down all these wonderful, delicious rabbit holes of information. And of course, there are other angel conferences that are held. And just websites and podcasts. So it's the whole thing. Like Brian O'Higgins said, you can really get caught up with a lot of time and energy in this space. Anyway, that's what helped for me.
Great. And maybe, I guess, Julie, you shared the story, but maybe both Brian to answer really kind of what brought you across the line on your first angel investment. What was, the difference and made you officially take the leap into this exciting journey? We'll start with Brian O'Higgins.
Just trying to think. My first investment, that was one I did a long time ago, and it's this company called Q1 Labs. I guess I just knew the team or some of the founders. They were actually in New Brunswick at the time. But I was, in that case, I was really familiar with the technology, and I came at it from that side, and thought we'd help form a company and help them spin out of university and form a company, get to the market. Now, over the years, then I made a lot of mistakes subsequently, looking at if I'm a fan of a certain technology area and I look at a company speaking that language and I think this is great, it kind of echoes with my ideas and I'm ready to back them, and complete failure. So like there's always three things, three broad areas I look at, the team, the technology, the market, of which 95% of it is a team. So it's just, you learn that over and over again, and it took me many years. But if they're smart guys, and even if they're talking about something new, which I don't have a huge affinity for, but I really want to back that team. And even I've been through deals where, or a company it's failed, but I really like the founders, and then they went and started something else, and I stayed with them for that, and that's worked. So it's, and as everyone also on the panel had echoed, the team is very, very important.
Brian Whitestone, how about your first investment?
Yeah, there's certainly a theme here, isn't it? And it's people. So like Julia and Brian, I'm kind of a people first investor. I mean, I look at lots of things. I look at people, moat, market, execution, but it's people first. And I once heard it framed in a neat way. I look for people who fit the Wizard of Oz criteria. That is, they have brains, they have courage, and they have heart. And well, I'm not going to talk about my first investment, but one more recent one has been Realize Medical. And very early on in that process, I met the founder, and I could just tell he was just motivated. He had everything it takes to be someone who can really pull his idea forward. And that really cinched it over the line for me. And obviously other things have to come in place as well. The financials, the space, does it make sense? But I'm very much a people first kind of investor.
Thanks, Brian. And to plug Realize Medical, maybe I'll let Julia and Brian O'Higgins plug one of their investments before we jump into the main presentation here. Any recent investments you're excited about, Julia?
It's so stressful to pick one. That's the problem. They're kind of like all my babies, but Neurovine, Ashley Kennedy is doing some amazing stuff. It's concussion therapy, helping people get better faster and not push too hard, but push enough. It's a fascinating combination of software and hardware, and I'm just dying to see how this turns out. But I know she's got some fantastic energy. She's certainly got the right background coming into this with a PhD, and I just think it's going to turn into something great.
Great. I'm a big fan of Ashley as well, so hoping for the best there.
Yeah, I was going to say your favorites are always the one that is got the most recent memory of something successful, And there's one that was they were in the news actually today. A company called Rewind. It's a very simple product that just backs up software for SaaS providers. So they started by backing up, provide a backup service for Shopify store owners. I was actually, I believe, the very first investor in that company, and they did a first raise. They only had 3 or 4 investors, and they raised like 150K. So I was with them from day one, and that was actually before they even, when I agreed to invest in a company, they hadn't actually incorporated the company. They were just 3 guys part-timing. 4th was joining them, and I just kind of, I didn't know them before, but I really liked that. I liked that team. They just felt good. And they've gone on for a couple of angel rounds and now a couple of VC rounds, and they're looking good.
Yeah, so I'll plug on top of that. Thanks, Brian, for bringing that up. So you'll see a lot of press around Rewind's big raise. For context, it was you'll see 15 million USD, 19 million Canadian going into the company at a valuation that's much higher than it was at the angel round. And yeah, we will not be listed in the press because I don't think anyone participated in this most recent round, but CAN members have been part of 3 rounds prior to that. So, and much like the CEO, Mike, this is the first time they're very outwardly public. It's a very low key company for many years, but Capital Angel Network has been kind of alongside them with during that journey. So it's great to see. Most recent success. Brian luckily has one from this morning. So, so with that, I will turn to Jennifer Francis, who's the chair of the board of Capital Angel Network, who's been a member with us for almost 10 years, I think. She will share her screen and start the presentation.
So can everyone see my screen? Thumbs up? Perfect.
Yes, but it needs to be like presenter mode. Yeah. Okay. Perfect.
Yeah. So I've been a member of CAN not 10 years yet. I think it's 7 or 8 years when I did my first angel investment, which was along with someone I'd been working with for a while. So again, people-oriented first investment. That was also my first exit, and it made money. So, you know, but your mileage will vary, which we'll talk a little bit about with angel investing. So from an agenda today, we'll talk a little bit just generally on angel investing, CAN or Capital Angel Network, then move into some of the more specifics around investing. So deal flow, investment steps, due diligence, little touch on term sheets and some of the government programs, and brief on after the investment. So sort of a whistle-stop tour of all the main areas and stages of angel investing. So first of all, what is an angel? So an angel investor is an individual who provides capital for a business startup. In Canada, there are regulatory requirements as to who can be an angel. This is by definition a high-risk investment, and therefore it's under securities control as to who can throw their money away. And if you do your first angel investment, you'll find yourself signing forms that say you understand you might lose all your money and that you may or may not ever hear from the founder again. All these nice big red flags, but really it's a lot more fun than that. But from a regulatory perspective, there are income or asset requirements to be able to do angel investing. So from an income perspective, either $200,000 of individual income or $300,000 of income together with your spouse. Or from an asset perspective, $1 million in investable assets. That means excluding your house from that $1 million, or $5 million in total assets, which could include your real estate or your house. So those are the basic requirements to be an angel investor. Why would you want to be an angel? Well, you've just heard from Julia, Brian, and Brian on some of the reasons why, but you know, it's interesting and it's fun. You know, if you're not having fun, might not be the right thing, but I think most people that do angel investing do it because it's fun. It's interesting in that you get to learn a lot. So, you know, Brian Whitestone talked about he wasn't a typical angel, but it doesn't really matter what your background is. You're going to be presented with things that are outside of that background. So there's lots of new things that you can learn, get to know. gives you the opportunity to stay current, what's going on in the market, what are all the cool new ideas that are out there in a lot of different areas. You can make some money, as Brian O'Hagan said. This isn't really a charitable endeavor. So as you're looking at angel investments, you should be looking at them with an eye on potential return. There's also, the mentoring and helping, a new entrepreneur or a new opportunity come to market and realize the potential, which is fun. Different backgrounds are really helpful in this area. Some companies need more help on the technology side, others on the business side or the marketing side. If you're not from the technology industry, you might have more insight into the potential customer side and be able to help, help your companies with understanding their customers and understanding their market better using that background. Most angels invest locally, so you're supporting the economic growth in your region or your country. It does give you some bragging rights, in particularly, if you're part of, something like Rewind today with their big announcement, and the bragging rights of being involved in that, as well as giving back to your community. While it's not a charitable endeavor, it does have that aspect of giving back and giving forward to new entrepreneurs and new opportunities. So I'm going to plug a little bit joining an angel group. So there are angel investors who invest on their own, and there's some who do that very successfully, but there's a lot of advantages to joining an angel group, which were alluded to in the Q&A or the panel earlier. So one is more eyes on a deal. It's easy to get caught up in your own enthusiasm in a deal. You might really like the technology or the market, or really like the founder, and you can wind up getting a bit biased or blind to other aspects of the opportunity. As people is the most important thing, but you need to understand people, technology, the moat, which is the differentiation, sustainable differentiation for the company, the financials, the market, the timing. So getting more eyes on that deal can help you with where your blind spots might be, so that you can get that holistic view of the opportunity. It allows you to leverage different backgrounds and experience. It's really good to have a very diverse group looking at a deal, so you don't wind up with groupthink. And groupthink can do two things. It can talk you out of a good deal, and it can talk you into a bad deal. So having diversity gets more discussion going and lets you really see the diamonds in the rough, and the polish that might not have much behind it. So both types of investment. It also gives you larger investment potential within a group. So investments typically in the group, individual check sizes will range from 10K to 100K or higher within a group. But you can look at deals that are trying to raise more money than that by having a group of people investing at the same time. And we'll talk more about this, but diversifying your portfolio, this is a key part of actually making a return on your angel investments. So using the expertise of peers within the group helps to diversify your portfolio so that you're not completely exposed to one sector or another, or one style of company over another. And you'll also, develop camaraderie amongst the group. A little bit harder always on Zoom, but one day we'll get back to face-to-face meetings where it becomes a little easier to build up that rapport and friendship with other members of the group. So angels are part of an overall investment ecosystem. So this is from research that NACO has done in terms of the investment landscape. You'll see at the early stage, when a company is just coming into that formation stage, they've come up with an idea. That initial very early funding tends to come from governments and incubators. So things like Invest Ottawa, Elspark, Startup Garage, Lead to Win, various programs like that. Friends and family funding, which could be just a couple of thousand up to, depending on who your friends and your family are, you might be able to get more significant investment from that. Depending on your product type, you might also get funding from crowdfunding. Some of you might have participated in crowdfunding where, there's a Kickstarter campaign or something like that for, a new cool piece of technology. Some of the early fitness watches and things like that went, got their first funding through programs like that. Then as you get into proof of concept, beta, testing of an idea, the bulk of the funding from there to early revenue comes from angels. And then as you get closer and closer to revenue and into revenue, the funding shifts from angels into more of the venture capital. And then as you get into mature companies, the funding comes from public offerings, private equity, commercial banks, et cetera. So just to, give a few examples, from the early stage, I talked about incubators. There's also pitch competitions, youth programs, other things like that. Few examples at the seed stage. So angel investors, so individual angels earlier on, angel syndicates for companies that are trying to raise more money. There's also funds like OCE, IAF that match angel investing, and IRAP funding. And then the growth stage, the institutional investors. So moving from that into Capital Angel Network. So our mission is to be the go-to place for early stage investment in Ottawa. So both the best place for entrepreneurs to come to get capital to build and scale their innovative businesses, and the best place for angels to come to be able to invest their money successfully. And our goal is to create wealth, jobs, and a vibrant community within Ottawa. We've got over 50 Ottawa area angels as part of the network. We invested in 20 different companies in 2020, which is similar. We invest in around 20 every year. This year we had over 4 million in direct investment with 12 initial and 8 follow-on investments. A follow-on investment is a second round. You would have heard that talked about a little bit in the panel, where a company like Rewind did several angel rounds before they did the VC round, and angels, participated in multiple of those rounds. CAN's been in existence since 2009. We've invested in over 100 companies to date. Julia mentioned SheBoot, which is a program for female founders, and our SheBoot top company, Heirloom, was the 100th investment that we made, which was pretty cool back in the, October, I guess that was. We've invested over 35 million in the Ottawa region, and those companies probably higher now since we got the Rewind announcement today. But those companies have raised over $250 million of capital to fund their companies. Our group is about 20% female angels. Our goal is to continue to increase that, and we're continuing to grow our portfolio of female founders. We are trying to make sure that CAN is able to support all founders within the Ottawa ecosystem. So different types of companies and different types of founders, female founders, visible minorities, Black and Indigenous founders. And to do that, we know that we also need to make sure that we have a diverse group. As the more diverse the group is, the more diverse the portfolio winds up being. So our goal is to both have a diverse portfolio and a diverse group to support that. So these are a few companies. You might recognize a few of the names on it. Rewind, we were talking about earlier. Neurovine's on here as well. But a good broad portfolio of companies in different areas. We invest in pretty much anything that has an innovation angle to it. So be it health tech, enterprise software, consumer, different, a variety of different areas like that. As you can see from the portfolio, autonomous vehicles as well. We also have exits. Exits are important as the exits are what brings capital back into the ecosystem with an exit that allows you to continue investing. So we'll talk a little bit about as you're looking at starting your portfolio, how you keep an eye on how you would get your equity out of the companies that you invest in, which allows you to be a continuous investor. From an angel group landscape, there are about 13 angel groups in Ontario. So we've got the Angel Investor Ontario is the sort of organized umbrella group, and then we have the 13 different angel groups. We have in Ottawa, other Ottawa area angel groups such as Purple Angels, Fundfire, Fresh Founders has done some angel investment. So there are a number of different groups around the ecosystem. The angel groups generally cooperate and syndicate deals. There are regions in the world where angel groups can be competitive, where they're competing for a deal, but largely here, our issue is not that startups are having too much money thrown at them, but more that they're looking to raise sufficient money to get to the next stage. So, if we can't raise the amount that the founder needs to get their company to the next stage, we'll syndicate with other groups to try and ensure that our founders are successful with their initiatives. And I think generally in Canada, our problem with startups moving to scale ups is not lack of ideas, but it's lack of capital. So syndication is intended to address that so that we can lean on other groups in order to provide sufficient funding for companies. Generally, from a process perspective, we will lead Ottawa-based deals and help our companies as they go to Toronto groups or other groups. And, if it's a Toronto company that we're investing in, generally we would be following on that, and one of the Toronto area groups would be the lead. We also borrow expertise from different groups. And we'll also recommend a deal if an opportunity is not a good fit, but we know another group has more expertise in that area. We might refer the founder to that other group, start there, and then come back to CAN when they've got a lead that can help them move forward if it's an area that we don't have the expertise in. So if you're thinking about being an angel, it is a high risk investment. I'm sure you've all heard of startups that were wildly successful. Here in town, an obvious one is Shopify, which is now the largest software company in Canada, from a startup 15 years ago. But there's also lots that don't make it. And it's really, really hard to tell when it's 3 people and an idea, which ones are going to be successful and which aren't. So generally, there's a few things that you want to consider as you get into angel investing. One is not putting all your money into it. Recommendation is at most 5 to 10% of your assets allocated to angel investing so that you can continue to live off the rest of your money as angel investments. Even if they are successful, which obviously some of them are, it can take several years to get that return because you do need an exit point where you can get your money back out. So those tend to take several years. So you want to make sure that you're not putting too much money into them. And you want to have diversification. So the larger your angel portfolio, the less risky it is. So, you want to be thinking about how you get to at least 8 to 10 investments for risk diversification in your angel portfolio. As you're doing angel investing, you want to think about the level of involvement that you can and should have in your investments. And, just from a time management perspective, as you can wind up spending all of your time on this if you want. But if you've got other aspects of your life, it's thinking through. So for your portfolio, a couple of times you might want to be the lead investor and have the biggest role within the angel group on that deal. You might want to have a board member position or an advisor position in some deals. Other deals, you might just want to be passive. You're letting someone else that you're working with on the deal be the lead, and that lets you manage a larger portfolio without running out of time in your day. You also want to think about, as you're looking at deals, most of your return on investment is going to come from 1 to 2 out of 10 companies. That's typical across the industry because it's really difficult. If it was easy to tell with 3 people and an idea who was going to be successful, we'd all be rich. But it can be hard to tell. So while you're doing the best you can at mitigating the risk on the early investment, you need to be thinking about the fact that most of the return is going to come from a couple of companies in your portfolio. So as you're thinking about that, when you're looking at an investment, you're really looking at each one. Can it give you sort of a 10x return on investment? Not that they will all give you 10x, but then if one of them gives you 10x, it covers the others, so that you wind up with a positive return overall on your portfolio. To run some numbers through, a typical angel investment is a $25,000 check. This is the most common check size across North America. It doesn't mean that you have to write a $25,000 check. There are companies where you can put in a $5,000 check or even smaller, but the most common check size across North America is a $25,000 check. So assuming that as a check size, 10 investments over time would be $250,000. You might want to reserve some money for follow-on rounds so you can double down on your successes. So keeping aside, for argument's sake, another $250,000. Now this is over time, so it doesn't mean you have to have all this money in year one. It's that you're looking at managing that portfolio so that you can build up an actual portfolio and that you can double down on your successes when they happen. You can also, as I said, smaller investments or shared investments. So for example, in SheBoot for the $100,000 prize, it was a shared investment approach with smaller checks from 10 different angels. Okay. In terms of stages of company, different angel investors have different risk tolerance profiles as well as different interest profiles in terms of when you want to get involved, what your risk tolerance is for getting involved really early or later, and the potential return on early versus later investments. So this is generally, you'll see that at Capital Angel Network, we have angels that invest at all stages. The smallest percentage of angels will invest in the idea or concept phase. That's before they actually have a product. So as I said earlier, in the overall investment landscape, that idea or pre-concept phase, that's typically funded through friends and family or incubators, government programs, things like that. But there are angels that get involved that early. And I've definitely seen angels write a check because they thought the idea was cool and they liked the founder. Most common are the next two, which is the early startup stage. So the company has come in, they've got a product, it's in a testing phase, or they've got their first customer. So those two, so the early startup stage through very early revenue is where most of the angel investment goes in Canada, and you'll see also in Capital Angel Network, that's where most of our angel deals are done, is between the beta/testing through to early revenue. Growth stage, so that's companies looking to raise to scale up once they've already got early customer successes and they're ready to now do a broader go-to-market. That is typically where you see the VC seed, Series A, Series B. There are angels that will go in with the VCs on those, and occasionally Depending on the company's capital requirements, those deals could be done fully within an angel if they're not looking for, $100 million to scale the company. So we do have some growth funding that's completely funded by angels, but more commonly it's angels in conjunction with a seed or a Series A fund. The sweet spot deal that we see, and this is a common deal. We obviously invest in deals outside of this profile, but a sweet spot deal would be a company that's in a beta or early release. As we saw, has a strong team to go with it. They're looking for 250 to 500,000 from angels, so it's a deal size that's easy to, with the 50 members in the group, easy to be able to bring that funding together and then augment it with programs like OCE, IAF, which are government programs. A company that has identifiable exit opportunities. So, they've been able to show, their exit potential of either acquisition or public markets. And typically an industry that does not require massive capital. It's easier as an angel to make a return on your investment if they're not going to need billions of dollars. As angels are sometimes squeezed out by VCs in those kinds of deals. Or even if they're not, it can be many, many years to see the return on that. Now, obviously, if you invest in a unicorn, you can make a lot of money. A professor I worked with at Waterloo, invested the first 150,000 into Google. Google's, obviously been a very good success for him. So moving on then, so if that's a sweet spot deal, how do we get good deal flow in front of members so that you can see these kinds of deals that have good opportunity for a return and fit that profile. So at Capital Angel Network, we have a screening process that we go through. So we typically have 15 to 20 applicants every month. Out of those, we have a screening committee that goes through those applications and picks 6 that we take to the screening meeting. So the first application round is written submissions. This says Gust. We've just recently moved to another tool. But we pick the 6. We then have a screening meeting where the committee listens to the 6 pitches, and we pick 3 that we think are the best fit for the Capital Angel Network members to see. And then we have a members meeting on a monthly basis where we present those 3 companies to the members for investment. So from there, the members express interest at that monthly meeting. So we've got a form that says whether or not you're interested. We have a follow-on meeting, which is called a deep dive with the founders, and all of the interested angels attend that. We typically circle around with just the angels after that to gauge everyone's interest. And this is where you'll see the benefit of working in a group because you've got a group of angels in that deep dive with the founders. So you'll hear questions being asked by different angels that you may or may not have thought of yourself that brings out interesting information from the founders that can help you make the decision on the investment. We then have a process that's called soft circling. So we go around, who's still interested after the deep dive. And that soft circling is not yet a check commitment. It's saying I'm interested enough that it is worth working with the founder in the due diligence. And the soft circling is basically saying that if the due diligence pans out, then I am planning to invest in this company. And we want to check that because due diligence takes the founder's time. And founders are busy trying to run their companies. So we want to make sure if we're going into a due diligence with a founder, that we're doing it on the expectation that they will get investment if it's successful. So we go through that due diligence process. And then at the end of the due diligence, assuming no big red flags showed up, then we go through the close, complete the paperwork, and transfer the funds. The due diligence phase is really a problem prevention process. So what we're trying to do there is a disciplined investigation to confirm the facts with regards to the investment. So this is where you're doing things like checking to make sure that the legal documents are in place, that the financials make sense, that they've got a marketing plan, that the people who they said are at the company, that they do the things that and have the skills that they said. So checking that everything that you learned in the deep dive is confirmed by the records and the people that you meet as you go through the due diligence. This should be a teamwork between the investing angels that lets you divide up the work so that no angels are doing too much effort in order to confirm the investment. And leveraging other angels, there might be an area where the angels that are interested in investing might not have the expertise in a particular area, but you could leverage someone else in the angel group who's got that expertise, even if they're not intending to invest. And I should say one more thing. If the due diligence turns into a stressful or confrontational process, it is a red flag for the deal. One of the things with angel investing, and we've talked about this a bit, but it's really people investing in people. So the due diligence, if it becomes confrontational, then as you move into the deal, it's unlikely to turn into a collaborative arrangement between you and the founder. So you want to make sure that you've got a rapport that you can work together, because as you invest in your startups, they're going to have up times and down times, and you need to be able to work with your founder on their strategies for funding, et cetera. If they do go through a downturn, or if they have to pivot and things like that. So getting to know the founder better during the due diligence will help you with figuring out whether you can work together post-deal as well. So I'm just checking where I'm at on time. Okay, got a few more minutes. So there are three main deal types that we do with angel investments. And they all have their pros and cons. The first deal type is an equity deal. So I will invest, X dollars for a percentage of your company. Typically in an angel deal, these would be what's called common shares, which is the same share type that the founders will have. It is probably the simplest deal type is an equity deal. Very simple in terms of understanding before and after the deal, what the ownership structure is of the company with an equity deal. It's very straightforward. The only issue that comes up, and I say only, but it can be a fairly significant issue. In an equity deal, you have to create a value for the company in order to determine the share price that you're investing at. So depending on the stage of the company, angel investors and the founders will sometimes punt that decision on how much the company is worth. And so the two vehicles that are used when you don't want to come up with a value for the company is a SAFE and a convertible debt. And I'll talk a little bit about the SAFE and the convertible debt. These become, from an ownership structure of the company, these become a little more complex than just doing an equity deal. But it does let you move the issue of how much the company is worth down the road to a subsequent deal. So a SAFE is a simple agreement for future equity. You're investing your money in exchange for the right to own equity in what's called a priced round. So the round where a price is put on the company and equity is done. The simplest SAFE is just, I'm going to give you, $100, and whenever you do a deal, an equity deal, my $100 will go in. Having said that, most SAFE deals have more terms around that. So typically they have a cap, which is, so my money will convert into into the company at the price of the priced round, unless the priced round is higher than the cap that I've set. So I might say, I'm going to do a safe and I'm going to set a cap at 5 million. So if you do a priced round at 3, I'll convert at 3. But if you do a priced round at 10, I'll convert at 5. And I might also put in a discount. So if you convert, so I'd have a 20% discount on the next priced round. So if it converts at 3, I would convert at 20% below that. And the reason I would do these things is to get what's called a risk return on my money. So I'm going to give you my money now to convert in the future, but I want some return on that investment that the future investors won't get, because I'm giving you my money now. I want a benefit for giving you my money now versus just waiting for the next round. A convertible debt is very similar to a safe. The difference between a safe and a convertible debt is there's a debt instrument that underlies a convertible debt. So that debt instrument says that if you don't have a priced round, I'm still a debt holder. So I can start getting interest payments back on that debt. And so typically you have an interest rate that comes in. So I might have an interest rate. I have a discount on the future conversion, and I may or may not have a cap in addition to that. But I've added in that debt. And as a convertible debt, if something happens with the company, I'm a debt holder and I have a claim on the assets of the company. Whereas if I'm a safe holder, I have no claim on the assets of the company. Basically, with those 3 things, I would strongly advise with term sheets is just to keep it simple. So whether you pick equity, safe, convertible debt, that you try and keep the paperwork as simple as possible. The more you try and negotiate into a term sheet, the higher the legal costs are for everybody. So you just want to look for a few things on it, a board seat to represent the angels if it's a large deal, what the conversion is, whether it's to preferred. Preferred says that you're going to convert in on the same share class as the next round. Common, you're typically converting in at the same share class as the founders, but not the same share class as the next round of investors. Information rights and pro rata rights. Pro rata rights is your right to increase your investment in future rounds. So government funding, it's good to have, and I'm not going to go through all of this, but we've got a lot of great government programs in Canada. And it's good to look at those, because the more non-dilutive funding you can get into your company, the lower risk that is on your angel investment, as you can get them better capitalized with the government funding, and gives them a lot more runway before they have to get to the VC round. So just finishing up, so those are some of the things in terms of getting into the investment. You also want to think about, as you're doing your investments, after the investment. So, as I mentioned earlier, involvement does vary from angel to angel. It will also vary deal to deal. I have some of my deals that I'm super involved in. I meet weekly or biweekly with the founders. There's other ones that I read their reports that they send me quarterly, but other than that, I don't really have much to do with them. I'm assuming somebody else is doing that, or I know somebody else is doing that. Where I've chosen to be more passive in those investments, and some I'm very active with. You want to be able to act as a sounding board. You want to be able to provide advice and assistance. And you also want to make sure that, you're opening up doors for them if you can. If they're looking at moving, getting investment from other angel groups, that you're going with them, that you're telling people why you invested and why you think it's a great investment. If they need particular resources, that you're looking at your network on how to help them. And providing help and providing your network and your expertise is just going to help them be more successful, which will also help you be more successful. And in the end, I think, as everybody said at the beginning, it's really about people investing in people, and with a few things around that you have to check. But it's really a people relationship. which makes it, a lot of fun, really interesting to participate in. Oh, and just a couple of other notes from Capital Angel Network. We talked a little bit about SheBoot. We've got, I think, around 60 women involved in SheBoot in various roles, from investors to advisors to educators for the founders. We'll continue to run that program annually, so there's opportunity to get involved in that. And we also have what we call a pitch award, which is a very fast investment that we make, typically $10,000 to $15,000 with 4 or more angels involved, which we give out right after the member meeting. And it's just a little kicker for companies that are coming to CAN if we really like what we've seen from that first meeting with them. And with that, I think we move into Q&A.
Yeah, that's right. Thank you, Jennifer. Virtual round of applause here. Well done. We had several. On time. Yeah, great. Actually, caught up because we were late on the panel too, so much appreciated. If only the founders stuck to the schedule that way more often. But so there were about 6 questions. There's a few that I answered directly in the chat, but 6 questions. The first one coming from Jay, and I'll address this to you. I may answer some, and Brian, Julia, and any other CAN members who are on the line, feel free to chime in and provide your answer, your experience. The first one is, does CAN interface with the incubators and accelerators to see what may be coming down the pipe and which entrepreneurs are showing promise, etc.? Short answer is absolutely yes. Maybe Jennifer, if you want to elaborate a little bit more.
Yeah, I mean, first of all, I'd just say thanks to Nolan for really reaching out and keeping abreast of what's going on overall in the ecosystem and the different incubators. We've also got lots of other touch points that helps with that. So, for instance, I mentor at Elspark and I'm on the board of Invest Ottawa. We've got several EIRs for Invest Ottawa that are members of Capital Angel Network. We also have people that work with Startup Garage at Ottawa U and other university programs like Hatch and others. So we've got lots of tentacles out from Capital Angel Network into the Ottawa ecosystem. That helps with staying in touch and making sure that founders are aware that they can get funding from Capital Angel Network and working with them on what the best timing is to come in.
Great. So next question, sorry, the question from LV. I'm leaving Cameroon, I'm living in Cameroon and would like to immigrate to Canada through the Startup Visa program. As an entrepreneur, can we support this and find a recommendable angel group designated by the federal government? So I can start with that one. So the Capital Angel Network is currently not a designate of the Startup Visa program, but I know a few that are. I can help connect with some of those, and I do know Yuri, who used to be the CEO of NACO, has started a new platform called Canada Ventures that is focused a lot around optimizing that process for companies that are trying to get into Canada through the Startup Visa program. So Elve, if you want to follow up, I think I put my email in the chat as well, Nolan at Capital Angels, and we can have a bit more of a discussion there. I don't know if there's anything else anyone wanted to add to that. Great. So next question is a bit of a two-parter from Jeff Blacklock. How do we as a network promote exits? And I'm presuming it's you, Jeff, you mean trying to find exits for the portfolio companies. And I think you've got a second part there, given that you were involved with an angel group out west, and it was talked about that their portfolio was, was a lot of Walking Dead, with kind of 90% of the portfolio sitting in that mode. Not sure, Jennifer, you want to start with that?
Yeah, I mean, we've had several exits, and we have quite a few portfolio companies that are now VC funded. Once you go into the VC funding, it becomes harder to be a walking dead, as VCs tend to either push you forward or cut you off. But yeah, in terms of promoting, I would say as a group, Capital Angel Network, we don't necessarily review all of the companies to see who might be, after investment. But the angels that do invest in companies, and in the DD process, it is something we discuss, is what are the potential exits for the company? How would I actually realize a return on my investment with these companies? And then as for the angels that then invest in the company, a good practice is to meet periodically with the founder on that exit strategy and their progress towards that. And also just tracking and promoting when we do get exits, so that, just keeping in mind for everybody that exits is what, whether it be to a public market or a private exit, M&A, et cetera, it's those exits that keep capital flowing to enable investment in new opportunities. So we track it, we discuss it as part of the due diligence and the process pre-investment, and then the angels, as I said, that do invest, it's really up to them to stay with the founder in terms of making sure that you're moving towards that objective.
Yeah, I've seen cases where angels have really helped a company with the introduction for business development. That's actually led to an exit. So, well, that's good. But of course, in general, you don't want to we're not out to force exits. They're out to, because a company that's growing as fast as it can and as best as it can has more opportunities.
And typically the angels individually, unless they're sitting on the board, don't have that kind of sway or power to push this forward. And what I'll say on our portfolios, we've got about 105 companies since the initial, since CAN started. There were 9 exits listed on the slide. We've had 2 more where the companies actually bought the investors out, which did provide a positive return. We've had 5 other exits that were at a loss. 14 companies are dead. So that's about 30 companies that are no longer active of the 105. I put another 6 or 7 truly in the Walking Dead category, but then on the on the positive side, now rewind being into that category, but about 9 that are well beyond the angel stage. So the on paper return is already fantastic. We've got another 9 that are kind of at the Series A stage, and then 20 that are at the seed stage, and then probably I'm counting 27 that are very much still at the angel stage, so recently closed an angel round, or maybe spinning their wheels at that stage, unfortunately, for a bit of time. So that's a bit of the breakdown of the portfolio right now. So sorry, give me a second on the chat here. The next question from Nish, who is actually one of our newest members. Thank you. Welcome to the network. Sorry, I lost it on the chat as people keep saying. Yeah, what types of deals are better fit for this group as CAN versus other angel groups?
Yeah, so the broader we get our membership, the more deals we're able to do, and lead totally within CAN, and then take out. I will say, there's been a couple of times when we've looked to Purple Angels to really do the deep dive, particularly when they're in telco, as that's a group that's heavily telco oriented. There's a couple of Toronto groups that are more inclined to do consumer type offerings. We don't have as much consumer products within Capital Angel Network. So if it's a consumer product, we might look at something like that. There was a while we didn't really have, I would say probably a broader Ottawa problem. But finance, fintech startups. For a while, we would have said that a fintech startup, you might be better starting in Toronto and then adding on in Ottawa. But we're building up more fintech expertise here. So, it shifts over time as the membership of the group changes, but you really want to look at, do we have someone or more than one person who's got real expertise in an area that we can really do a useful job for the founder in terms of ensuring that they're properly capitalized. And that's where, we will look at another group who might have more members with a specific expertise, like Purple Angels and Telco.
Yeah, I think the other area that we've evolved a bit more on is biotech and life sciences. Something that we really didn't do, the first 5-6 years of the network. That's something we hardly ever touched. But now, between folks like Brian and a few others, it's really broadened out. So we have people who have some level of expertise and can kind of validate the technology and the biology a little bit more. And then we see several other people investing, whether it's, from an, overall interest or an impact lens or things like that. So two of our biggest deals in 2020 were, one was Virica Biotech and the other was Spyport. So both very deep technology life science company, which is something that we'd not have touched probably 5 years ago. And that was something that a group like Ange Quebec had a little bit more of a specialty in. So yeah, it's definitely evolving.
Yeah, and I would just add to that, Nolan, that people need to recognize that Ottawa is a great source for those types of deals with stuff coming out of OHRI and the like. So there is a lot of that flow coming from Ottawa, so it's good to be able to support that.
The next question from Usay, is there a standardized framework or structure that the Angels use to conduct due diligence to make sure they don't leave any stone unturned?
So we do have a due diligence checklist that you can go through. I will say it varies a little bit based on the risk profile of the angels involved in a deal. Some deals, the angels involved go through in a great deal of detail, everything on the checklist. They do the customer calls. There are angels who, are fine to just write a check after they've met the founder. So there's a bit of variety in the process that's followed, but we do have the artifacts for the due diligence checklist and the process and the questions you should ask, so that you can go through and make sure that you've I don't know about no stone unturned, but de-risk as much as possible the investment that you're making.
Anyone else with comments on that? Okay. Next question from Mark. Yeah, and again, he mentioned that the panelists did touch on this a little bit, but any additional perspective? How long would you recommend, viewing pitches and engaging with startups before actually, going through the investment process and writing your check? I've got my own answer, but I'd love to hear from others first.
I'll tackle that first. There was a study done, I don't know how long ago, that said the median number of hours in due diligence should be about 20. Now, do I follow that rule? Not necessarily. I think there is definitely a strong correlation between the amount of time you spend and the return on investment in terms of multiples that you'll get. In other words, making a quick decision is not necessarily well advised. So I think that's one.
And actually, sorry, Brian. I think I may have missed. I kind of tried to summarize the question. I think he's speaking in terms of a bit more of what Julia mentioned of, as she was advising Invest Ottawa and engaging with a lot of startups without actually investing in any. How long do you, maybe watch pitches, look at companies before really jumping in and investing? And again, I'll say, one of our angels, his best investment was the first pitch he saw, and he wrote a check right away and made a lot of money off of that. But that's not usually the norm. But yeah, I'd love to hear everyone else's experience and viewing and educating themselves on this process before really jumping in.
I would say that I probably jumped in again, with the first check, earlier than I would have. I just happened to have developed a full relationship for about 6 months with the founder, gotten to know the business from a bunch of different aspects. I'm talking about, I don't know how many conversations we would have had, but literally at least 20, 25 hours of conversation, understanding the business, where it was going, et cetera, over that period of 6 months. The next investment took me longer. And that's when I would attend deep dives and just listen, without really the intention of investing, just to try and figure out what everybody else was interested in, and how the conversation went. And I probably did, a few months, 3 or 4 months of that kind of listening to deep dive conversations before I started entering into the next investment.
Yeah, I was going to say a lot of people, it's easy to jump in too quickly, and that's the caution. Because I think Jennifer mentioned that you get really excited about something, and then you want to, people want to pile in.
Yeah.
So just the dynamics with the angel group help so much, because you might think it's a great idea, but you could be delusional, and then someone else, you realize has either direct subject matter expertise or connection to it, and that helps so much. So I don't know, the more I always like to get slightly involved and see, as you see more deal flow, it gives you more confidence in your abilities to, if you see something and you kind of decide you like it, you're easier to nail that conviction down and say, I really like it, I'm going to go and proceed in deeper, in more detail. Experience helps.
Yeah, I think that seems to be a common answer, is to definitely spend a few months looking at different opportunities from a wider lens. My challenge, even as the director, is I want the new members to get engaged and participate and hopefully make their investment sooner than later, so it doesn't drag out and you churn out and lose interest. But really, ideally, yes, you're spending a few months just listening and learning before really leaning in.
And I'll say I wrote checks for the first couple of ones that I looked at, and then realized that wasn't really sustainable. You can't, I see a lot of companies, you can't write checks for all of them. You have to be a little more discerning. So then, sitting back, spending a little time, seeing a lot of companies, and then from that, working through which ones are the best ones for you to invest in, and taking more of a strategic view of the portfolio that you're trying to build up. But it is pretty easy to get caught up in the moment.
Yeah, the pitches all sound really good. Usually, that's the challenge up front. It's looking under the hood where the truth comes out.
Yeah.
Question from Daryl: how do you deal with safe deals when the timelines get broken, or basically the company doesn't hit the milestones, and there's maybe probably no follow-on fund or conversion event?
Yeah, so this is a real issue with safe deals that you need to think about. One is, when the company gets broken, but there's another case where you've got an issue with a safe, which is the company doesn't get broken. The company actually turns out to be able to get to profitability without a priced round. So the company is successful, but your safe never converts. So you need to think about those cases as to whether or not safe is the right vehicle. Occasionally, so I've got a couple of safes, which are, I would say, kind of pseudo safes, where there's a conversion milestone written into the safe that it converts to equity after a period of time. So just like a convertible note, typically in a convertible note, after 24 months, the company starts paying back interest on that note and starts paying back the note. With a safe, you might write in that if there's no conversion event within 24 or 36 months, that the safe converts to equity at the cap, and have that automatic conversion, even if there's not a priced round. And you want to do that for these circumstances. The big one being no follow-on round, but the company is successful. Obviously, if the company fails, it really doesn't matter which vehicle you've written up to lose your money. The only benefit of a convertible note, if the company's not successful, if it's a company that has assets, where you might be able to get something back on their IP portfolio or if they have physical assets. But other than that, generally, if the company is not successful, it doesn't matter what you've inked. The real issue with safes is if the company is successful but didn't need a priced round, where you need to factor that in. And you can usually get a sense for the market that they're in, is there a possibility that they can get to revenue and profitability without a priced round? Some sectors like most life sciences, biotech, need so much money that won't happen. But there are companies in markets where they can do that. And so you need to think, is the safe the right vehicle? Should you just be doing an equity, or should you have a timeline in your safe to automatically convert if there's not a priced round?
That's an excellent answer, Jennifer. I don't think I've got nothing to add there. I think that's it for the questions from the audience. I'm not sure if there's anything else. Yeah, feel free to continue to add them to the chat, or even at this point, unmute and ask the questions directly. Maybe Jennifer, I don't know how much of an introduction you did actually about yourself and maybe plugging one of your investments, but maybe I'll throw it to you to do that.
Sure, yeah. So my background is high tech in software. I had worked at Cognos, Watchfire, IBM, as both Cognos and Watchfire were bought by IBM. But all software background. I've been doing startup mentoring, advisory work, angel investing since 2013, 2014 timeframe. My portfolio, probably, actually, I don't know how big my portfolio is. I should know that. About a third of my portfolio is female founders, mix of different types of technology that I invest in. Some med tech, SaaS, various other ones. I've had 2 successful exits, a couple of failures, and many that are still going concerns, but haven't yet resulted in an outcome. So I joined Capital Angel Network after my first angel investment, and have been on the board for 5 or 6 years, I think. I would highly recommend joining a group. I think it's been great for me as an experience working with the group. If you're interested but not sure, we do allow guests to come to meetings. So you can come to a meeting, sort of see what the process is like. It's a little bit different now on Zoom, but equally entertaining, I'm sure. Joining us on Zoom, and then at some point in the next 12 months, hopefully we'll be doing some in-person events as well. But it's a great way to just see what the process is like. Get to know different people that do angel investing, and decide whether that's the right move for you.
Thanks, Jennifer. And I'll add, I guess, yes, our next event is on our next week, January the 26th, from 1 to 4 p.m. If you're an accredited investor, we would love to have you join us. I will be sending up a follow-up email to everyone with a link to the recording, the presentation that Jennifer gave, along with some links for resources for the NACO book, the Practical Guide to Angel Investing that we mentioned. And I will share just additional information about our next couple events if you can't make it on Tuesday, as well. I'll link the book if you want more specific details about what membership entails. There is one more question here in the chat from Mark. So one of the things, Jennifer, I think you mentioned is, a way to limit follow-on investment or dilution. Kind of there's a challenge that the angels get crunched down as companies raise more and more money. What are the considerations that you'd have kind of at the angel stage in order to limit that potential dilution?
Yeah, I think the main thing to look at is, if you're investing in companies that require a lot of capital, is understanding the the potential size of the market for that company, to make sure that there's room for the valuation of the company to go up commensurate with the amount of funding that they need in order to be successful in their market. Right. And there are companies that, there's a few case studies around of companies that have raised money, but the market doesn't really, there's not enough market potential for the amount of money that they've raised, right? So if I raise 10 million from a VC, I need to be able to get a 10x return on that. That's what the VC is looking for. So they're looking for their amount to be worth 100 million. So my market has to be, hundreds of millions or billions, right, for the VC to get that return. Otherwise, what happens is preferred rights tend to come into play. So if the market turns out not to be big enough, the VCs will come in. If you ask for a pref series A, the VC will get pref series B. There will then be a later round with a pref C. And that will determine who gets their money out first. And this is where angels can run into trouble, is if the market's not big enough for the VCs to get the return that they need without the pref rights coming into play. Right. And so your original investment doesn't come out because the company wasn't able to get their valuation up high enough that that you got out of those pref rights, and that all share classes got the full return on investment.
Yeah,
So
that's what I've seen has been the issue. And sometimes there's an exit, but it's the valuation is below expectations. So the preference stack is not crashed, and then common shareholders get screwed. So that's unfortunate. You can't ever predict these things, but hopefully we don't see them often. But if the company's doing well, growing fast, valuation's increasing, dilution's annoying, but I mean, it's not a big deal because you gain more in the valuation and everyone, it's a good exit. But we're often in the same camp as the early investors at common shares, or see the same pace as the employees and founders.
Yeah, so it's really advising your founder that, to keep the amount that they're raising in line with, where they can take their valuation of the company and what the real market opportunity is. If they need to raise, $50 million, but they're in a market that's only worth a couple $100 million, it's not going to, the math doesn't work.
Yeah, and I think the couple other pieces too is ensuring initially that the dilution to the founders and the founding team isn't too high up front. Typically a venture deal, they're taking about 25%. That's what they'll ask for. Angels, ideally, you're probably taking a little bit less, as the whole round consisting somewhere in the 15 to 20% range of the company, because otherwise down the line, then the founders themselves are also crunched down. And then the other piece too, mentioned as well in the chat around pro rata or kind of tag along rights. Again, I think that's not something it was mentioned in the presentation, but we didn't go deeply on it. And maybe Brian, particularly, again, I think you've had to evaluate a couple of companies recently around investing, calling your pro rata, investing some more or not. And maybe you can talk us through those decisions as well.
Well, it's nice to, early on, I never paid a lot of attention to follow-on investments. And then these companies had a great exit, but my dilution, I still did okay, but it could have been way better. And then you kind of rethink that. And as Jennifer highlighted in her presentation, have some allocation for follow-on. So it's important to keep that opportunity alive. It's a bugger to lose pro rata rights. If you don't do follow-on, then you're shut out of that opportunity. So all things to consider. When you see something becoming a winner, it's kind of gets easier to talk yourself into backing the winner and keep putting more money in. Of course, all could go wrong, but it's a lot of people don't get to the stage where you get subsequent rounds and sign a good progress.
Okay, we are at 1:27, so only a few minutes left. With that, I'll probably wrap up. I've mentioned all the items that I'll do my best to share within the next 24 hours. Again, thanks to you to Jennifer, Brian, Julia. Brian Weinstein had to hop off, but again, shout out to him as well for participating. And thank you everyone for the great questions. And hopefully we'll do this again sometime in the coming months. And whether it's a 101 or a 102 or a 201 type of level topic will be TBD. But thanks again for signing on.
Thank you. Take care. Bye.
Hi.
All right.